Hey everybody, it's Sean. I'm working on trying to get this precise, and it seems as though I can only do either my screen share or a video of myself, and I'm not quite sure why I can't do both. So if you have an answer to that, could you please put that in the comments below? But today I want to talk to you about the psychology of investing, and basically, to win at investing, it doesn't necessarily mean you have to be the smartest, brightest, although that helps, right? But kind of the key to it is really the psychology of investing, making sure that you're doing it not based on emotion, but based on a tried and true system. So, let's get into this real quick. And if you have comments, questions, or suggestions, I would appreciate if you put them in the comment section below. I will also do a poll throughout, at one point here, and want to get your feedback. So anything you can share will help, and there will be a prize for someone. So hopefully, in order to do that, you need to comment and provide value or content back to the rest of the community. So with that said, I'm just going to move forward here and walk through this presentation with you. And, hopefully this is going to be really helpful to you to help you be one of the people that succeed at investing. So the psychology of investing is what this presentation is called. And I'm going to be doing a webinar on it soon, but you guys get the sneak peek right here. So keys to investing. The number one important thing is investor behavior, which we alluded to. It's creating a disciplined approach to investing. The next thing that's important is how you allocate your investments, how you allocate your stocks, bonds, alternative investments, and so on, what asset classes you're in, and so on. So that's important. And often overlooked is taxes and estate planning, because you can amass all the money in the world, but if you give, a 30, 40, 50% of it back to the government, that could be really costly. Same thing with estate planning. When when we all eventually leave this earth, we want to leave as much as we can to our family, friends, to the charity of choice, but most of the time we're not trying to leave our money to the government. So it's important to consider those things in our plan. Here's a question for you. I'm going to put up a polling question right now. Which of these would you pick? If you had a choice between investment, we'll call it the red investment, the green investment, the pink, or the yellow, which one would you pick? And I'm going to put a poll question here so that you guys can answer that question for us. So let's see if we can kind of put that up here, and I'm going to activate the poll and see what your thoughts are. So let me know. And if the poll doesn't come up, let me know in the comments below. But tell me also at this point, which one would you prefer of these particular options, okay? Next, we're going to tell you a little bit about these. So if you pick the red option, you chose to invest your money in Pfizer. If you chose the green option, you would have chose to put your money in the U.S. stock market S&P 500 investment. If you chose yellow, it's U.S. Treasury bills. And if you chose the pink, it's a Fairfield Century. So if you want to know more about any of those, let me know. So you're saying, okay, well, I picked the red one. Look how smart I am. I picked Pfizer, and it's way up above where everybody else is. So I started with $2 at the beginning of my experiment here, and I ended up with just under $18. Isn't that awesome? I'm so smart. But the thing here is we have the privilege of hindsight, because this is looking at now and looking backwards and saying, okay, well, here's where I ended up. But at any particular time along the way, you didn't actually know that was going to happen. So let's assume you invested here in Pfizer, and then somebody else invested in the S&P 500. Over this particular period of time, we're all about the same, right? So our money is in the same place. Then what happens is Pfizer starts taking off and really going up. But what happens along the way is we see dips, a dip from a high point to a lower point, a higher point to a lower point, high point to a low point, so on and so on. What would happen if at this particular point here, where it was at 16 and then it went down to 12, you decided, you know what, this is too rich for my blood. I can't take this. I just had $16 and I'm down to 12. Or worst case scenario, you invested at 16 and went down to 12. Be honest with yourself. Would you have sold at this point? Would you have sold at 12 and, lost $4 a share? And then when you see it going back again to 14, would you have bought back in? And then potentially when it went down to 11, would you have sold again? So on and so on. Here it went up to 15. This is where you bought back in and then immediately saw a drop again, would you have sold out? And that's the point here. In each of these down periods of time, that's when people get scared and get out. So if at any of these points you were in and then the market went down, none of us know where the bottom is. So if it went down here, you're saying, oh my goodness, let me get out. Now I'm down to $8 and I invested at 16. You're getting out thinking that it's the end of the world. And then you're getting back in sometime near a new peak, a new top. And that's where over time, getting in and getting out, which we'll refer to a little bit more, a little bit further in the video, getting in and getting out is going to cause you issues of you start here, you lose money. You start here, you lose money. You start here, you lose money, and so on and so on. And so you never actually get to the point where you start at $1 or $2 and get all the way up to $18 because you got out beforehand. Oh, sorry about that. So, in 1720, Isaac Newton lost a fortune in the South Sea Company, the hottest stock in England. He concluded that he can calculate the motions of heavenly bodies, but not the madness of people. What does that mean? Sometimes stock markets adjust downward for no good reason, or sometimes stocks go through the roof for no good reason. So don't buy just because everybody else is buying, and don't sell just because everybody else is selling. Make sure you understand your plan. And this is exactly what Warren Buffett said. We don't have to be the smarter than the rest. We just have to be more disciplined than the rest. Super important to remember. Keep in touch to keep our emotions in check. Things that affect our investments are one, envy. Well, the other guy just made so much money on Bitcoin or this or that latest thing that's exciting. Maybe GameStop or whatever. I want to get in too. Sometimes you're getting in a little bit too late and you miss the big bubble or the big up point. 2, when I have losses, do I get out? 3, am I building the building? Am I building the discipline that I need to be successful? So with envy, it's regret, the lottery ticket effect. So basically, am I looking at this and saying, well, look at GameStop, it's going up, now it's at 200, let me get into it. Is that a good move, or are we really at the point where, well, we missed out on it and the fundamentals of this are not the best? The risk that we're taking is much higher than we'd imagine, and pretty soon it's going to be crashing down because the fundamentals aren't there. That's often what happens to a lot of us. Interesting fact is that bronze medal winners, slightly off, now we're in Olympic times, are happier than silver. Why? Because it's, man, I just missed it. So on a scale of 1 to 10, bronze winners have registered a happiness of 7.1 versus silver 4.8. Because I was just about there, I almost had it. And so emotionally, it's I'm happy that I placed versus, man, look what I just missed out. And fear of missing out is something that will really, really get us. So let's look at an example since 2000 to now, and looking at the S&P 500 compared to a diversified portfolio. Diversified means not just having our money just in one S&P 500, but having it between stocks, international stocks, small companies, emerging markets, bonds, and so on. So what happens during 2000 and 2002? The S&P 500 lost 40%. The diversified portfolio lost 17.3%. You're thinking, I lost money, I'm really sad, this is terrible. If you're in the diversified portfolio or in either one. 2003 to 2007, the S&P 500 went up 82%. So we can see a period where money was down, where things were down, is followed by a successful period of upward mobility. Okay? So if we stayed invested after 2002 and we waited, even though we were down 40% or even though we were down 17%, if we waited and didn't take our money out, just let it ride from 2002 to 2007, our money went up 82% or 80%, okay? You might be looking at your diversified portfolio and say, I only went up 80%. S&P 500 went up 82%. Man, I didn't make as much as the S&P. Again, emotion is going to allow us to say, wow, I didn't make as much as the S&P 500. That's terrible. The next period in 2008, we all know what happened there. The S&P 500 went down 37%. If you had a diversified portfolio, you're only down 24%. But you're still thinking, I'm down 24%. You're not necessarily comparing to the S&P 500. You're just upset because you lost money. Then in the next period of time, 2009 to 2019, the S&P 500 went up 351%. Your diversified portfolio only went up 195. You're again saying, man, I didn't make as much money. I wish I was in the S&P 500. So on and so on. I'm not going to read all this to you. But if we look at the highs and lows, the ups and downs, over the course of 20 years, the total return on the S&P 500 was 268%, where a diversified portfolio is 275. So all along we're thinking, oh, I lost money or I didn't make as much as the S&P 500, but we end up ahead. Wouldn't you rather 375 versus 368 when you're looking at your overall return from $100,000 to start? I think we'd all be happy in a diversified portfolio, and sticking it out's key. Moving on. So we'll just kind of pass over here, but here's what a lot of people are buying lottery tickets, and that's in the market as a lottery as well. You're just investing and getting in and getting out, and you're not really disciplined, and you're just really losing out. So single stocks, the next great thing, the next big thing, or the investment trend, like Tesla or GameStop or any of those things. We're getting in when it's too late. We're basically gambling. Let's put that aside and do disciplined investing. That's the focus of what I'm saying today. So we looked at Pfizer early on, and we said with it when we're looking at Pfizer that we're at a situation where it really did well. But if we try to pick just certain individual stocks of the U.S. stock in the U.S. stock market, individual stocks, about 66% of those did well, and 34% of them lost money. When we look at mutual funds, it's a diversification, right? It's diversifying into a whole bunch of different stocks. So we don't have to worry about picking the winner and the loser. All we have to do is pick funds that have so many different companies, and we're more likely to be the winner than the loser. So here's something else that's really valuable, and I've shared with clients a lot over the last couple of years. So when you look at money that you have invested, and what the situation might be. So let's say your portfolio goes down by 10%. Let's use $100,000 for example. If that goes down by 10%, how much do you have? $90,000, right? Now if the market goes back up 10%, what do you have to get? Where do you end up there? 90,000, 10%, you have $99,000. You're not back to the $100,000. So in order to get back to even, you don't need the market, when it goes down, you don't need the market to go up 10%. You need to go up 11%. Same thing, if you go down 20%, you need to be up 25% to recapture the loss you had. So on and so on. So if you lost 70%, you need 233%, or 3.3 times the amount of money in order to get back to where you started. So really important to consider mitigating risks and understanding what a risk of a 10%, 20%, of a 30% down would how that would impact us, and whether or not we need to make adjustments to our portfolio to mitigate risks. And there's definitely ways that we can do that. So with losses, what do we like to do? We like to act, right? We like to get out. Oh my gosh, this is going down. Let me get out right away. And we'll use Pfizer as an example. If you got out right away, it was not a good thing for you. In any of those times that when it went down, getting out was the wrong answer. Now, if you're looking at a stock and the company's filing for bankruptcy and bad things are happening, then yeah, getting out might be a good solution. You don't want to ride it all the way down to zero and into bankruptcy and to dissolution. But sometimes it's better to hold on if the company is sound and say, okay, Pfizer was at 18, now it's down to 12. Let me buy some more, as opposed to let me sell what I have, because now I can buy it at a cheaper price than what it was a couple days before. So don't follow the herd and just sell because everybody else is. Sideline sitting is another one where, oh my gosh, the stock's going down. Let me sell before I lose too much. And then we sit on the sidelines. It goes from 18, goes down to 12. We sell at 12. And now we sit there. It goes up to 13, 14, 15, 16. And now we buy back in again. So we bought originally at 18. We sold at 12. And then we bought back in at 16. Not the way to go. So that's the idea of here are the mindsets when it comes to losses. Are the fundamentals of the company still good, especially when the market tanks or goes down as a whole and people are just getting out? You don't want to be that person getting out. You want to look at that as a buying opportunity. Interesting fact here, statistics show that the best penalty kick for goalkeepers is best for them to stay right in the middle, but they usually jump to one side or the other too soon. And that's what we're doing. So we got to overcome this mindset to try to outsmart everybody else and do what's right for our portfolio, for our investing. Another point is time in the market versus trying to time the market. And that's what we talked about before. When do I get out? How do I get out? Do I buy in and sell? Let's use again our Pfizer example. And what happens if we miss out on several best winning days, right? So we're sitting on the sidelines during those days. So for example, I bought the stock at $18. It goes down to $12. Let's assume the following day it bounces right back up to $15, let's say. It's still not at 18, but we sold out at 12 and it went back up to 15. We lost $3 a share because we were sitting on the sidelines. So this is an example of missing out on the market over the last 20 years, ending in 2020. If we took $100,000 and in one scenario we left that $100,000 in for the entire 20 years, the next scenario and so on is we're missing certain days in the market. So here's where your situation might be, okay? If you missed the best 5 days of the market because you're sitting on the sidelines, instead of your money having stayed in Pfizer or stayed in the investments the whole time, your $100,000 in the S&P 500, if you stayed in for 20 years, would have went from $100,000 to $424,000. More than almost 4.5 times the money. If you missed just the best 5 days that the S&P 500 did, so you were out during those 5 best days that it had, you missed those 5 best days. Instead of having 424,000, you only have 268. And if you missed the 25 best days, because again, you're buying high, selling low, buying high, selling low, you just missed 25 days of it going up. You're on the sidelines for 25 of the best days. You only have $92,000. You actually turned your $100,000 into a loss as opposed to riding it out and turning your $100,000 into $424,000. Nobody wants to be here. You wouldn't even want to be here compared to there. So again, best to invest and stick with it over the long haul as opposed to trying to time the market. Nobody ever wins timing the market. They might win in the short term, but not in the long term. Another thing is waiting for the right time to invest. So sitting on the sidelines, waiting for the right time to come, just, waiting 5 years. I'm young, I'm 25 years old. I'll start investing when I'm 30. Well, look what happens if you invest $100,000 at year 0. So let's say today versus waiting 5 years from now. Assuming a 10% annual yield, which is not too crazy. It's moderately successful. It's a good return. $100,000 today in 10 years could be worth $259,000 at 10%. If you wait just 5 years, putting the $100,000 in would only be worth $161,000. Big difference there. I'd rather be at red than yellow. Let me know if you agree. Put that in the comments below. Would you rather wait or would you rather start? I have a lot of clients that are putting in even small amounts of money over the next couple of years. Maybe it's $50, $100 a month. Maybe they start with $5,000 and they work their way up. By being in, you're getting growth. By waiting, you're not. So get in sooner than later. I can help you. I'm not going to say you have to come to me with $100,000. I'll help you no matter where you are. Warren Buffett, another thing he says is be fearful when others are greedy, be greedy when they're fearful. In other words, when the market's going down, that's the time to buy. When everybody else is, buying and buying and buying, it might not be the best time. Keep that in mind. What do you think so far? Take a moment to go down to the comments section and tell me what your thoughts are so far. What do you think of the information that I've been sharing? Anything missing? Any questions? That kind of thing. Let me know. I'd love to kind of get your comments and thoughts in this regard, so I can provide you with better content going forward too. Building discipline. That's the key. That's what we're really talking about. Talking to a financial professional, someone like me who's going to help you. I'm not going to be emotionally invested in, I'm going to be invested in helping you out, but I'm not going to be as emotionally invested in what you're doing as you will be. So that will allow me to help you in many ways, because I can kind of help talk you off the ledge and help you stay disciplined in your investment. Just like anything else in life. When a friend comes to you with a question or concern, something impacting them, something they're worried about, what do? You come to it with perspective that they may not have in the situation. And that's what I can bring to the table and help you with, not just tools and investment options, but also helping you, with advice and guiding you through the process. And that's what I'm here to do. Prepare for the worst before it happens. What would I do if the market's going down? Is there ways I should hedge? If I'm concerned about the market going down, what do I do? But also, how do I avoid selling in a panic and coming down here or selling here and end up missing out on this part? So those are the strategies that we talk about and prepare for ahead of time, so that you can create success and not be selling low and buying high. Interestingly enough, you can see a lot of things from pundits on TV, and again, the most important thing to consider is discipline, right? The Wall Street people are going to tell you, buy more of this company, sell more of that. And again, they're using analytics. They're educated. They're doing their thing to give you the best information they have. But most of them were not predicting 2008. Most of them were not predicting what happened in the beginning of 2020. Nobody expected this virus to hit. Nobody expected necessarily the 30% drop that happened in 2020. And definitely nobody expected that when it did drop, that it was going to turn around and bounce right back right away. It's the people that are fearing that wind up in trouble, in bad situations. So interestingly enough, they said a coin flip, a 50-50, has been more successful than Wall Street experts. So look at the investments, look at the value that the investments bring, look at the future of the company, but don't just go off of what somebody said and what a pundit said, and don't make a move based on just something that you're hearing, or a reaction, or get out right away. So here's just a number. We're going to go through this really quick, but become a disciplined investor. We've talked about that before. So take a moment, pause the video if you want, read through this if you want to get a little bit more detail and understanding from there. As we mentioned, key here is don't allow your emotions to impact you. So that's the presentation for now. That's what I wanted to bring to your attention. That's what I wanted to provide you. Let's do it for our families. Let's do it for the legacy. Let's do it for the future. Let's do it right. Let's not lose money. Too many people lose money because they're investing in these, quick, I'm going to make lots of money real quick. The people that really make the money, as you've seen here, are the disciplined investors that hold on for a long time. So thanks for checking this out. If anybody's here this long, if you're here till the end, message me and tell me this keyword that I'm going to say, and the keyword is BlackRock. So if you separately send me a instant message or tell me BlackRock, because that's who gave me this presentation, I'll know that you stayed till the end here, and I will have a gift card for you if you stayed and watched the whole thing. So thanks so much, and we will see you the next time I do a video. Talk to you soon.